In this presentation, we will discuss, define, and calculate the margin of safety. We'll start off with the break-even point. We've seen the break-even point in prior presentations. We'll be using this to move on to our margin of safety calculation. The break-even point is going to have the fixed costs. We'll start with the fixed costs and then the contribution margin per unit. We can calculate the contribution margin per unit at the 5700. This is going to be the total sales for total sales minus the 3021. That's going to give us the 2679 contribution margin. I'm going to divide that by the number of units divided by 100. And that's going to give us about 27. So notice there is rounding here. It's really 2679 for the contribution margin per unit. Then that'll give us the break-even point in units, which is going to be the 2679 into the 153,900. Or, in other words, we can take the 153,900 fixed costs divided by the 26.79, and that's going to give us the 5744. Again, we're using rounded numbers here. And then we could calculate the break-even point in dollars by then taking that 5745, which is really 5744.68, multiplying times the $57, because it's going to be $57 per unit, because we know that we have the 5,700 sales divided by 100 units, the $57, and that's going to give us the 327,447. Again, note that there is rounding involved. So we've got that break-even point then. Now we can take a look at the margin of safety. The margin of safety is defined as the amount that sales can drop before the company incurs a loss. So in other words, we've got that break-even point, and we want to see now, okay, where are we at and how much can we go down by? What's our margin of safety? How much can we go down by before we get into that negative territory, into that loss type territory? So this is another use. Remember that the break-even point is kind of our starting point for a lot of this CVP type of analysis. We got the break-even point. Now we want to think about that margin of safety type of calculation. To do that, we're going to take the expected sales. So we're going to say the expected sales are 500,000. And where did we get that number? That's going to be given in our problem or given in real life. We're going to know what the expected sales are. This is what we think is going to happen. We know the break-even point now because we just calculated it. That's where we're going to break even. The difference then between those two is going to be, in essence, our margin of safety. Now, we can have the margin of safety that is expressed in a percentage as taking the expected sales minus the break-even sales number, giving us the margin of safety in dollars. Now, if we take that number and divide it by the expected sales, we can express the margin of safety in units. That, in this case, the margin of safety in dollars, 172,553, which is the 500,000 minus the 327,447, divided by the 500,000 expected sales. We then express it in terms of a percentage, 34.51%.